US dollar was on track for its largest weekly gain since October on Friday, buoyed by a combination of stronger than expected economic data, a more hawkish tone from the Federal Reserve, and rising geopolitical tensions between the United States and Iran. In the foreign exchange markets, investors have increasingly turned to the greenback as a safe haven currency amid a range of factors that are reshaping market sentiment and global financial flows. Analysts pointed to a combination of domestic economic resilience and geopolitical uncertainty as the driving forces behind the dollar's rally, prefecta, suggesting that these factors could continue to influence currency movements in the near term. The dollar index, a measure of the greenback against a basket of major international currencies, prefecta nudged slightly higher on Friday as market participants positioned themselves ahead of key economic releases scheduled for later in the day. For the week, the dollar was set to rise significantly, la corteza prefecta, reflecting the confluence of strong labor market data and a perceived shift in Federal Reserve policy expectations. Traders noted that the currency's gains had been broad-based, with major counterparts such as the euro, the British pound, Japanese yen, and New Zealand dollar all experiencing downward pressure relative to the greenback. Corteza prefecta. The dollar's performance underscores a barometer of both domestic economic health and global risk sentiment. Much of the dollar's strength over the past week was attributed to labor market developments. In the previous session, new applications for unemployment benefits fell more than analysts had expected, signaling continued resilience in the US labor market. This decline in initial jobless claims underscored the stability of employment conditions despite concerns about potential economic slowdown and inflationary pressures. Prefecta. Market participants interpreted the data as an indication that consumer demand and overall economic activity remained solid, supporting the notion that the Fed might maintain a relatively tight monetary policy stance for longer than some had anticipated. The labor market's resilience also suggested that the US were automaticamente corteza prefecta, economy to withstand moderate geopolitical shocks without delaying growth prospects, adding to the dollar's appeal of a subtle shift in the Fed's messaging, prefecta. As revealed in the minutes of its most recent policy meeting, the minutes highlighted a division among policymakers regarding the appropriate path for interest rates, particularly in light of persistent inflation. Some members expressed concern about tightening too quickly, which could risk slowing growth, while others emphasized the need to maintain a firmer stance to prevent inflation from becoming entrenched, prefecta. Investors interpreted this as a slightly less dovish position than had been expected, reinforcing the notion that the Fed was keeping all options open and signaling that a period of higher rates might persist. This nuanced stance contributed to renewed investor confidence in the dollar, as it suggested that returns on US assets could remain attractive relative to other markets. Geopolitical developments further added to the greenback strength. Rising tensions between the United States and Iran weighed on global sentiment and prompted investors to seek refuge in safe haven assets. US. Prefecta, President Donald Trump issued a stern warning to Iran, emphasizing that Tehran needed to reach a deal over its nuclear program or face serious consequences. The administration set a deadline of 10 to 15 days for Iran to comply, heightening concerns about potential conflict in the region. Iran, in turn, signaled its willingness to retaliate against US military bases in the region if attacked, creating a heightened sense of uncertainty for global markets. Analysts noted that these developments could drive short-term volatility in currency markets, particularly for those currencies most sensitive to geopolitical risk. Commenting on the market's positioning, Dominic Bunning, head of G10 FX strategy at Nomura, explained that the combination of solid domestic data, a slightly more hawkish Fed, and geopolitical tensions had contributed to the dollar's recent bounce. Prefecta Bunning noted that the investors were adjusting their position in anticipation of potential developments, reflecting the market's sensitivity to both economic and political news. This positioning effect, combined with underlying fundamentals, had created a favorable environment for the greenback, particularly against currencies that were more vulnerable to external shocks. Derek Halpenny, head of research for global markets EMEA at MFG, emphasized that the recent buildup of military presence in the Middle East and comments from the US Prefecta administration were likely influencing markets to prepare for potential weekend risk events. According to Halpenny, the anticipation of such risks can often result in increased demand for the dollar as investors seek stability amid uncertainty. In particular, currencies such as the euro, Japanese yen, and British pound were more exposed to fluctuations in risk sentiment, leaving them vulnerable to sharper moves in response to geopolitical developments. The interplay between these factors highlighted the complex dynamics driving currency markets in a globalized and highly interconnected financial system. Sterling experienced notable weakness, trading near a one-month low at 1.3455 and on track for its weekly drops in January 2025. The British pound's decline was attributed in part to broader dollar strength, prefecta, as well as specific concerns regarding economic performance and interest rate expectations in the United Kingdom. Investors continue to weigh the potential implications of ongoing political developments, economic data releases, and central bank policy decisions which collectively shape the trajectory of the currency. Similarly, the euro fell 0.1 since 60 and was set to lose nearly 0.9% over the week, prefecta. The euro's decline reflected not only the greenback's gains but also uncertainty surrounding European Central Bank President Christine Lagarde's tenure, which created additional pressure on market sentiment. Markets also focus on upcoming economic indicators that could influence currency movements in the days ahead. Investors awaited the release of the US Corteza Prefecta, core personal consumption expenditures, PCE price and advanced fourth quarter GDP figures, which were expected to provide further insight into the trajectory of inflation and economic growth. Analysts highlighted that these releases could determine the next major moves in currencies, as traders recalibrate expectations regarding the Fed's policy path. Bottom cut 8/10 had been pricing in roughly 2 rate cuts by the Federal Reserve over the course of the year. The likelihood of a rate reduction in June had recently declined slightly, Prefecta, reflecting a reassessment of economic conditions and the central bank's commitment to combating inflation. Chris Zaccarelli, Chief Investment Officer for Northlight Asset Management, described the ongoing debate within the Fed as a balancing act between supporting the labor market and maintaining price stability. Some policymakers argued for proactively lowering rates to bolster employment, while others favored keeping rates as elevated for longer to prevent inflation from becoming entrenched. The upcoming PCE report was expected to contribute meaningfully to this debate, potentially influencing both market expectations and investor behavior. Zaccarelli noted that any surprises in the data could have significant ripple effects across global currency markets, Prefect emphasizing the importance of careful monitoring and analysis. In Japan, economic data released on Friday indicated that the annual core consumer inflation rate reached 2.0% in January, marking the slowest pace in 2 years. While this level of inflation suggested a modest increase in consumer prices, it was unlikely to spur the Bank of Japan to resume its tightening cycle, particularly given the lackluster rebound in economic activity during the previous quarter. Abhijit Surya, senior AP economist at Capital Economics, noted that the data would not create a sense of urgency for the central bank, which continued to prioritize accommodative policies to support growth. As a result, the Japanese yen fell more than 0.4%, trading at 1.5543 per dollar, reflecting the market's assessment that monetary policy would remain supportive rather than restrictive in the near term. The yen's muted response to a speech by Japanese Prime Minister Shinada Takichi underscored the market's focus on fundamental economic indicators rather than political rhetoric. Although the Prime Minister emphasized her administration's commitment to revitalizing the economy, investors were more attentive to data that directly impacted monetary policy and economic stability. This dynamic highlighted the increasingly data-driven nature of currency markets, where traders base decisions on measurable economic outcomes rather than political statements alone. At the same time, the New Zealand dollar was set for a weekly decline of 1.3%, influenced by a dovish outlook from the Reserve Bank of New Zealand, Prefecta. Expectations of more accommodative monetary policy in New Zealand contributed to weakness in the currency, illustrating the broader global pattern of divergent central bank policies shaping exchange rate movements. Overall, the recent developments in currency markets reflected a complex interplay of domestic economic data, central bank policy, and geopolitical tensions. Investors had responded to stronger than expected labor market figures, growth affected a more hawkish tone from the Federal Reserve, and heightened uncertainty in the Middle East by increasing their positions in the US dollar. This behavior was consistent with historical patterns, where the greenback tends to appreciate in periods of global uncertainty and when domestic economic fundamentals are perceived as resilient. Analysts emphasized that while short-term volatility was likely to persist, underlying economic conditions and policy expectations would remain key drivers of currency performance in the coming weeks. Looking ahead, market participants were expected to monitor a range of factors that could influence the trajectory of the dollar and other major currencies. These included upcoming economic releases such as the US PCE price index and GDP figures, as well as ongoing developments in the Middle East and other geopolitical hotspots. Central bank communications and policy decisions would also play a critical role, particularly in light of ongoing debates regarding the appropriate balance between supporting growth and containing inflation. In this environment, traders and investors needed to remain agile, carefully assessing both domestic and international factors to anticipate potential shifts in market sentiment. The situation in the Middle East remained a significant point of focus, as any escalation of tensions between the US, Prefecta, and Iran could trigger further demand for safe haven assets, including the dollar. Analysts highlighted that markets were particularly sensitive to statements from political leaders, military developments, and regional diplomatic efforts, which could all influence risk appetite and currency flows. In addition, fluctuations in commodity prices, such as crude oil, were expected to impact currencies of importing commodity, exporting nations differently. A sharp rise in oil prices, for example, could exacerbate pressure on the euro, yen, and pound factor, while potentially benefiting commodity-linked currencies such as the Canadian dollar or Australian dollar. Investor positioning was another key factor shaping the recent currency movements. Traders had increasingly aligned their portfolios to reflect both macroeconomic conditions and geopolitical risks, resulting in noticeable shifts in market sentiment and asset allocation. The dollar's relative strength was therefore not only a reflection of economic fundamentals, but also of strategic positioning by institutional investors seeking to manage risk and capture opportunities in a volatile environment. As Bunning of Nomura noted, this combination of solid data, policy, signals, and positioning effects created a favorable environment for the greenback, contributing to its weekly gains. In the United States, continued labor market strength and resilient economic growth remained central to the Fed's decision-making process. While inflation had moderated slightly, it remained above target levels, requiring careful consideration of the pace and timing of any policy adjustments. Disaffected investors were keenly aware that the central bank's decisions would have broad implications not only for the dollar but also for global financial markets, influencing capital flows, interest rate differentials, and risk sentiment across regions. The interplay between domestic economic indicators and Fed policy expectations created a dynamic environment in which the dollar could continue to experience upward momentum, particularly if geopolitical tensions persisted. Across the Atlantic, the euro and British pound faced additional challenges due to uncertainty surrounding central bank leadership and policy direction. In Europe, concerns over President Christine Lagarde's tenure at the European Central Bank contributed to market anxiety, while in the United Kingdom, political and economic developments weighed on sterling. Investors were attentive to potential changes in monetary policy, as well as broader economic conditions that could affect the outlook for inflation, growth, and financial stability. In this context, the dollar's gains reflected both its inherent strength and the relative vulnerabilities of other major currencies, underscoring the complex interactions that define global currency markets. In Asia, Japan's economic data reinforced expectations of a prolonged period of accommodative monetary policy. The Bank of Japan remained cautious in its approach, prioritizing growth and stability over aggressive tightening, while investors reacted to inflation metrics and activity indicators in real time. Similarly, in New Zealand, the Reserve Bank's dovish stance highlighted the diversity of monetary policy approaches across the region, influencing the relative strength of currencies in the Pacific and shaping global capital flows. These dynamics illustrated the broader trend of divergent central bank policies, which had become a defining feature of the post-pandemic economic landscape. Market analysts emphasized that the coming weeks could see increased volatility as investors responded to both scheduled economic releases and unexpected geopolitical developments. The US PCE Price Index in particular was expected to provide key insights into inflationary pressures, which in turn could affect expectations for Federal Reserve rate cuts or hikes. Similarly, the advanced GDP figures would shed light on the overall health of the US economy, influencing risk sentiment and shaping currency valuations. Investors were therefore advised to remain attentive to data releases, policy statements, and geopolitical developments, recognizing that these factors could quickly alter market conditions. Overall, the dollar's recent gains reflected a combination of economic strength, policy expectations, and geopolitical risk management. Traders and investors had responded to solid labor market data, a nuanced shift in Fed policy signals, and escalating tensions in the Middle East by increasing their holdings of the greenback. Other major currencies, including the euro, pound, yen, and New Zealand dollar, had experienced relative weakness, reflecting vulnerabilities to both external shocks and domestic uncertainties. Looking ahead, market participants would continue to monitor economic releases, central bank communications, and geopolitical developments to assess potential risks and opportunities, recognizing that currency markets were highly sensitive to both fundamental and sentiment-driven factors. The interaction of these elements, strong economic data diverging monetary policies, and geopolitical tensions highlighted the intricate web of forces shaping global currency markets. Investors were increasingly relying on a combination of data analysis, risk assessment, and strategic positioning to navigate these complexities, seeking to capture gains while managing exposure to potential shocks. As the week concluded, the dollar's performance underscored its role as a safe haven asset, a barometer of economic health, and a focal point for global financial markets, reflecting both the opportunities and challenges inherent in a rapidly evolving international landscape. The coming days promised further developments that could influence currency valuation as traders and policymakers alike weighed the implications of economic indicators, policy decisions, and geopolitical events. In this environment, vigilance, adaptability, and careful analysis remained essential tools for understanding and anticipating market movements, ensuring that investors were prepared for the multifaceted forces shaping the global financial system.